Hi, welcome to the podcast today. And my name is Udit Rati. I am a mortgage agent at Pineapple Financial, a level 2 mortgage agent actually. And today we have a special guest with us, the BDM from NPX. Why don't you introduce yourself?
Yeah, thanks, Udit, for having me on the podcast today. Like Udit said, my name is Eton, and I am the BDM from NPX. And I think we're going to go into the lender specifics after.
Yes.
But a little about me. I've been in the industry for about 8 years.
That's
Been at
nice.
NPX for about two. And during those 8 years, had a combination of experience in both the credit side, back office, and now working on the sales side.
Oh, that's nice.
While I'm not doing that, I really enjoy basketball. Pineapple had a charity
Yes.
3v3 event over the weekend, and I have to say that's probably my favorite Pineapple event to attend every single year.
Oh, that's great. And how are you finding, like you have been at NPX for 2 years now? How do you find NPX?
You know what? Over the past 2 years, we've gone through a surprising number of changes. We've changed leadership a couple of times. Our programs have pivoted
Yeah.
along with market conditions, just like every other lender. But I'm happy to say that most of the changes that we've undergone, looking back, have really positioned us well for the spring and the
Oh,
summer of 2024. So, whether it's
that's
on the
nice.
sales side or the credit side, our processes are much more streamlined.
Oh, that's
And
nice.
yeah, it is. And while the change process might not be comfortable, the end result is certainly
Yeah.
one that I'm very much enjoying.
We will definitely get into the process later, how you make mortgages simple.
Definitely.
So let's start with the first time home buyers. Everyone talks about first time home
Sure.
buyers first, and I do know that you have a contract rate qualification program.
That's right.
So how does that help?
So, as an alt lender, we don't have the 5% down first time
Yes.
home buyer program. All of our programs are at least 20% down. But as you just pointed out, our key value add for customers is that contract rate,
Yeah.
no stress test qualification. Most lenders, especially if you're looking at an insured mortgage, let's say you're being offered a rate of 549, you're qualifying at 749.
Yeah.
And because of that, the hurdle is higher and the loan amount you can get is smaller. For many first time homebuyers, they haven't been at their jobs very long, which means their income probably isn't as high as, let's say, their parents or their aunts and uncles. And so, by being able to bypass that stress test, they can boost the borrowing power a little bit, even on their first home. And therefore, if they thought they could only afford a condo, maybe now they can afford a townhome, right? And
Yeah.
if they could only afford a townhome before, maybe they're looking for a single family dwelling now. And that, I think, means a lot to first time home buyers.
Okay, that's great. And one thing I would like to ask, like, as you said, you don't have 5% down. We need a minimum of 20% down payment to qualify with NPX.
Correct.
But there is an option of gifted down payment as well.
Mhm.
So can the whole down payment be gifted, or you need some of it to be from the borrower?
Right. So that is case by case. I can say confidently that we have done many cases where the down payment is fully gifted, even on rental properties.
Yes.
The key though for gifts is that we want them to be from an immediate family member. Once you get into the second aunt, third cousin, that's when we might look at it a little bit more scrutiny. But if it's, parents, children, grandchildren, grandparents, that is certainly a situation we see a lot and we're very comfortable with.
Okay. And one thing I would also like to point out here is that if your parents own a home and they have equity, they will refinance it as well, and you can use that as down payment for your next property. That's correct.
Absolutely.
Yeah.
And another added benefit for us is that we also allow customers to borrow down payment,
Yeah.
right? So let's say they have a line of credit,
Okay.
right? We don't really recommend them taking down payment from credit cards,
Yeah.
right? But let's say they have a line of credit, whether it's secured or unsecured,
Okay.
we're able to use that as down payment, provided we include a certain amount in debt servicing.
Okay. That sounds great. And continuing on to first time homebuyers, the market is difficult. And like this contract rate program actually helps them a lot, because if someone's qualifying for an amount that they're not happy with, they
Mhm.
can definitely go with you and they'll get qualified for a higher amount.
Correct.
And personally, what I feel like, your rates are not that high.
Hmm.
When I compare you from the other alternate lenders out there, your
Hmm.
rates are very nice. And let's, if we continue on to first time home buyers, a lot of first time home buyers to get into the market are also looking to be investors,
Hmm.
because coming 2024 and 2025, we are expecting that the market is going to see a little bit of boom in 2024 and a good amount in 2025.
That's right.
So can a first time home buyer be an investor?
Absolutely. And that's something we're actually seeing more and more commonly.
Yeah.
There used to be a more traditional view that before you buy a rental, you have to have your own owner occupied. But Canada being so multicultural, there are certain cultures where family stays together. But if they have capital lying around, what better way of investing it than in real estate?
Yeah.
So it's absolutely possible for first time home buyers to not have an owner occupied property, live at home, but still have a rental. The difference from a practical standpoint is that we need to include what is called a shelter cost
Yeah.
into liabilities, but that's a strength because at
Yeah.
NPX, we just need a shelter cost.
Yeah.
We will work with the borrower and the agent to adjust what that shelter cost is to find a solution.
That's great. When coming to the first time home buyer becoming an investor, we can also add rental income to the income for the qualification of their purchase. So that actually gives them a higher power. Is that correct?
That is correct. And I would also like to add on to how that income can be treated. Uh, so there are usually two ways that lenders used to be able to look at that rental income. The first one is, as you said, you take whatever income they earn monthly, you take either all of it or a percentage of it, and you add it to their income. And obviously that helps. But there is a more effective way of utilizing that income, and that is you take either the whole thing or a percentage of it and you offset it against whatever debts they might have.
Yeah.
And without getting into the details of the mathematics, that second method is much more advantageous
Yes.
when it comes to qualifying.
Yeah.
It is a shame that most lenders now are scaling back the use of that second method, which is called the offset,
Yeah.
at least on the subject rental. But we're happy to say that NPX, we are still offering that offset on subject rentals, which has helped a lot of customers get into that first home, as you said.
And comparing you to a regular bank usually adds 50% add back to the income,
Hmm.
and your 80% offset is way better than that. And personally, in some cases, like 80% offset is actually better than the 100% add back as well.
Hmm.
And this is something for you to note, that how NPX can help you buy your property. And I would like to discuss a scenario here,
For sure.
which actually you approved for me.
Awesome. Yeah.
And it was a first time home buyer looking to purchase a property, and he was living with his parents, and we wanted to buy an investor home for that person. So first thing, the property price was $660,000 in Brampton, a very nice property.
Hmm.
And the second thing, we were able to use the rental income very easily. We just had to do a market rent appraisal, and we were able to use that. Do you remember how much the income was?
Wow, you're really testing my memory here. You're going to have to remind me.
Okay. So when comparing to a regular lender, like it's usually like everyone says, you get a mortgage amount qualified for, that is like 4 to 4.5 times your income.
Yeah, that's usually a good approximation.
So for $660,000 house, according to that, you will need approximately over $130,000 of income.
Yeah, like 80%. Yeah. That tracks.
That the person that you approved for me, that person's income was $72,000.
which
So
which is a healthy income.
yeah,
For a single person, that's a healthy
that's a
income.
healthy income. But most of the home buyers are outed by the market because they don't qualify.
Yeah.
And we were able to use 80% offset
Hmm.
We added that to the income,
Right.
and the person was able to qualify.
Right. And I think this also highlights the value that you add, I think, to customers too, Udit, because when you compare us to the banks,
Yeah.
one key difference, and sometimes this is underemphasized, is that any customer can walk into a bank
Yeah.
and get the same offer that you're getting them at the bank,
Yeah.
right? However, the contract rate qualified option or feature that we're talking about, customers can't come directly to us to get it.
Yeah.
They have to go through a mortgage professional like you,
Specifically me.
especially you,
Yeah.
right? One who's done it before,
Yeah.
right? So I think that's also one reason why any customers watching this, there's a reason why customers are shifting towards mortgage agents, because the options they have are far beyond what banks can offer.
That's correct. Thank you so much for that. And again, like, it's good that we mortgage agents have a lot of options.
Mhm.
But when it comes to first time home buyers, a person who already owns a property, they are much more comfortable going with a B bank.
Sure.
But a first time home buyer, uh, they almost think that a B lender, that's a downgraded bank, I don't want to go with it.
Mhm. I certainly agree with you that there is an overall stigma against B lending, right?
Yeah.
And I think a lot of it has to do with the name itself, right? If there's A lending and there's B lending,
Yeah.
well, A just sounds a lot better, right? The way that I describe alternative lending, which is synonymous with B, but alternative lending, is we are a stepping stone. An analogy that I've used with some consumers is that we're a ladder, right? You're trying to get here. Maybe your situation is here, and to bridge that gap, you use a ladder, right? But a ladder, when you climb on, it's something temporary. No one climbs on a ladder and decides, I'm going to stay on this ladder forever.
Yeah.
Eventually, once you get to where you need to go, that ladder disappears. The same with alt lending. We are trying to help you get your customers to that A lending level that they want to be at. And they will get there. But don't hesitate to use us as a stepping stone as you build your income, as you build your credit. And before you know it, the customers will be at exactly where they need to be.
That's correct. That was a very nice way of explaining how to get. And one thing I also know is that you are a part of a very big mortgage player
We
that's
are.
under Paradigm.
Correct.
You also have a side,
Correct.
that's Lendwise Merix.
Correct.
So you can actually help the person get from a B side to an A side when they qualify.
That's correct, right? So we work very closely with Merix, right? Once at the mortgage at the end of the term, we don't automatically graduate customers to Merix because we want you as the mortgage agent to evaluate options at that point and make sure that you're doing what's best for your customer. We don't want to make that decision for you,
Yeah.
right? At the same time, not only are we affiliated with Paradigm Quest, we're actually owned by MCAP now,
Yeah.
right? So their best practices have begun to trickle over, and truth be told, our best practices have benefited them as well.
Yeah.
So with the backing of Canada's largest mortgage financing company, as you pointed out, certainly does bring a certain level of advantage to us.
Yeah. So even though you are a B lender, let's that what a lot of people would say,
Sure.
but you are a part of a very big mortgage player, and actually that's the biggest apart from non-bank lender.
Correct.
So that is actually, like, that is a point that should make you feel more comfortable going with NPX.
Correct. Do you mind if I just touch on that B alt lending side a little bit? Because in the A side, what I find is that that space, and it's designed to be that, it's not a fault of the space,
Yeah.
right? It's designed to be a little bit narrower, right? They know exactly what type of customers they want. And if they fit in that box,
Yeah.
they're going to get approved. But if they don't, that's when we step in. Whereas in the alt space, it's more of a spectrum of people that fall in there.
Yeah.
You have people on one hand that are very close to A, some people that are a little bit farther,
Yeah.
and some people that might need even more time to
Yeah.
get into that ACE space. And in some cases, some lenders within this spectrum, they decide to maybe just cater to one subset of customer.
Yeah.
One thing that makes NPX unique is that we have an all-inclusive suite of products.
Yeah.
From near prime all the way to what we call near private. And what our underwriters are trained to do is once you've told us a story surrounding a customer, we will help you figure out. Obviously, the decision is still yours, but we will help you figure out which bucket the customer fits in, not only to meet their short term needs, but to help them get to their long term goals faster. And I think that is a unique offering within the industry to have that flexibility and to be able to cater to a wider range of customers.
That's nice. And yeah, we'll be ending the first time home buyer with just one last question.
Sure.
Uh, Renewals. A lot of people ask me about that.
Yeah.
A lender that is not a bank, do they offer renewals? And my answer is always yes. But another thing on your part, like you said, you have near prime as well. So you
Correct.
offer 5-year fixed terms as well.
Mm-hmm.
So that actually helps me actually describe it better to the clients.
Of course.
And just confirming with your own words, you do offer renewals, regular renewals like any other bank, right?
We certainly do. And an advantage of renewing with NPX, and this is really thinking long term at the time of origination,
Yeah.
is that we have one of the lowest renewal fees in the industry.
Yeah.
The renewal fee, no matter what product you're in, is a flat $300.
That's nice.
So the thing about the alternative space is that sometimes things happen in life. Maybe there's a sickness, maybe somebody got laid off. You might have to be there a little bit longer than you'd expect.
Yeah.
But at the time of renewal, you know that we're not going to put your customer in a tough spot by charging them another percent, by charging them thousands of dollars. 300, and we'll happily roll them into a new term.
Fantastic. And if you have any other questions for us, just leave a comment or reach out to me. My contact description would be below. So we have been talking a lot about first-time home buyers now, and a lot of people. Canada is made from immigrants all over the world, and a lot of people coming into the country, they come in with the dream of owning a home,
Right.
and they want to achieve it as fast as possible.
Mm-hmm.
So how does NPX help? Like basic, like majorly A lenders, they do like 3 months of employment and some down payment, and you can qualify. But do the same contract rate qualification and the same offset or add back? Can we use it for new to Canada people that are coming into the country?
We can, and the requirements surrounding us are very similar. We are a make sense sort of lender, right? So in terms of people who are new to Canada, like you said, 3 months on the job generally is good. We do need them to have a work permit.
Yeah.
And we want the remainder of the work permit to be at least 6 months to a year.
Okay.
So if there's only 2 months left, we might want to see the renewed work permit before we look at their application. But we are very welcoming of newcomers to Canada. And like you said, like my family was new to Canada at some point, and we were able to buy a house thanks to the way that the Canadian banking infrastructure is set up.
And one thing, like with work permit, it's actually quite difficult because of the non-residential speculation tax.
Sure.
And that's almost 25%. Not everyone can do it. There are some exceptions to it though. But let's leave the work permit thing apart because
For sure.
that's. But if a new permanent resident comes to the country, or if it's a new person, let's say has been in the country for less than 2 years, they don't have credit. So, do you look at alternate credit sources as well to qualify?
Yes, we can, right? So we like to see consistency in rents. If it's their first purchase, they must have been renting somewhere. So a landlord letter is usually something that we can look at. If they've paid utility bills, cell phone bills, that's also something we can use as an alternative to a credit score.
That's good. So, what would be your first few tips for people who are new to the country?
First few tips, I would say don't be afraid of credit.
Okay.
If you were offered a credit card, um, I would say take it
Okay.
and don't leave the balance at zero. The way that credit bureaus work is that you build your score quicker
Yeah.
if they're able to see that you're utilizing the credit and paying it off on time. Secondly, I would say while we don't want to have too many credit cards open, don't be afraid of having a higher limit, but using a small portion of it.
Yeah.
To give an example, let's say somebody has about $1,000 worth of expenses every month where they put on their credit card. The way that the credit report will look at that balance is this. Let's say your limit is only 1,500.
Yeah.
If you're using 1,000, the credit report will pick up 1,000 out of a 1,500 limit. You're using 67%, I think my math is right, of your limit at any given time. Now, our scoring system is such that the less credit you use, the better your score will be.
Yeah.
So think of another example where let's say you have a $5,000 limit, you're still using 1,000 of the balance, but now the credit report thinks you're only using 20% of utilization, and that will help the score too. So two things that come to mind immediately is don't be afraid of credit and find ways to limit the percent of utilization, whether it's increasing the limit or reducing the balance.
And one good way of doing this would also be don't close your old credit cards. If you are getting pre-approved for new, I tell my clients that if you are
Yes,
pre-approved for a new credit card, take it, but be mindful of the utilization. Don't exceed 35% of it, and
exactly.
you'll be in good hands. And another thing that I would like to share for new to Canada: pay your rents on time, pay your utilities on time. Don't have
Absolutely.
any non-sufficient balance fees on your account statements.
Mhm.
That would kill your deal.
Yep.
And yeah, that's basically new to Canada. It's not that difficult to qualify.
Hmm.
In some cases, I feel like it's actually simpler to qualify a new to Canada person
Right.
because they just have to show, like, they do need a 2 year history in usual cases.
Right.
But documentation is not required for that part, for the
Right.
earlier employment history that you have in the country
Right.
that you are coming from. But you do need 3 months of Canada,
Hmm.
and that's all we need.
I would also make a suggestion, maybe not on the credit or income side, but on the down payment side.
Yeah.
When you're new to Canada, it's natural that you have most of your funds in the country where you came from.
Yeah.
Canadian institutions, whether it's banks or non-bank lenders, we want to see that money at a Canadian institution for at least some time before funding.
Yeah.
So another suggestion surrounding down payment would be don't wait till the last minute
Yeah.
to move your money over because that could delay your deal. Get it into the country 30, 60 days ahead of time, and you will be able to avoid a lot of potential issues.
That's right. And that's a great point, and I would recommend that keep it for at least 90 days into your bank account so that you have to go through minimum of documentation, because sometimes documentation is something that a client gets bored of and it feels too heavy on their head and you get frustrated.
Correct.
So do it as soon as you can.
Right.
Okay, so new to Canada is done.
Awesome.
Let's move on to investors now.
Cool.
So investors, there are people who have been in the country for a long time now. This is not new to Canada.
Right.
And they own multiple properties, or they want to become investors and they want to buy multiple properties.
Mm-hmm.
So how many maximum number of properties under NPX can a person own?
So that's a great question because it can vary depending on the type of customer, right? So you had mentioned before that we have a contract rate qualified program.
Yeah.
That program looks at a maximum of 4 doors
Okay.
at the moment. So I emphasize doors because, for example, pardon me, if a customer owns a duplex,
Yeah.
that's considered two units,
doors.
which is 2 doors.
Yeah.
We have a more competitively priced stress tested program that can go up to 6 doors.
Okay.
And our near private program that goes up to 10 properties. So that's true properties, not
Yeah.
yours.
That's amazing. So a minimum of 4 and maximum of 10,
Correct.
depending on the product you are going to go with.
Exactly.
And we talked about offset earlier.
Correct.
Do we use the same offset in this case as well?
We do. And one thing that makes us special is that we can use the offset on both subject as well as non-subject properties.
Okay.
As long as it's not a lived-in property, owner-occupied with a basement,
Yeah.
it's an 80% offset across all properties that we can take. So
That's
a
amazing.
significant improvement in the ratios.
Yeah. So talking about ratios are something that determines how much you qualify for. And there are ways you can decrease those ratios so that you qualify for more. 80% offset on subject and non-subject properties is a lot more better than 50% add back that you will be getting at a regular bank. You will qualify for way more, and plus the ratios are more flexible on the B side with NPX.
Correct.
So you actually qualify for a way higher amount than you would qualify for at a bank. And yeah, I don't think I have any other questions on.
Couldn't have said it better myself.
Okay, so I am, and we touched a little bit on credit for new to Canada.
Right.
And now let's talk about people who don't have great credit.
Sure.
This is not new to Canada again.
Sure.
This is just for regular people. For life happens.
Yep.
And sometimes the credit is harmed because of it.
Mm-hmm.
So, do you support bad credit with an explanation or without an explanation?
I think we are similar with most lenders in the sense that every lender, regardless of A or alternative, want customers that have a proven track record of
Yeah.
paying. After all, we are in the mortgage business, right? So we like customers that can make their contractual payments. Having said that, we are understanding of customers that have ran into credit issues. We're able to service customers that have isolated bankruptcies or
Yeah.
consumer proposals in the past. So one occurrence is okay.
Okay.
Once you get into multiple, it becomes a much harder file to look at. But interestingly enough, we don't see too many customers with lower credit scores because of bankruptcies or missed payments. We see quite a few low credit scores because of utilization.
Oh.
That has been a trend that we've been seeing.
Yeah.
And that's why earlier when you said 35% utilization, don't go beyond that, is so important. You can make good payments, repay them on time, but if you're consistently at 70 or 75%, it won't put you in an optimal situation.
I think the economy has a bit to do with it right now.
I agree.
And inflation is getting better, but still things are very expensive.
Yeah.
And especially like groceries went over the roof in the last 2 to 3 years.
Oh yeah.
And that is something causing people to spend more onto their credit cards.
Mm-hmm.
But continuing on to it, let's say a person has a lot of credit card debt. Do you do debt consolidation as well?
We absolutely do. As of end of last year, I think CMHC published a report that said that the average consumer debt to income ratio for the average Canadian is 170%.
Oh.
So for every dollar of income that Canadians earn, they owe $1.70.
And I think that has increased significantly in the last 2 3 years now.
Yeah, it was on an upward trend. And you know what? Some of that debt is what we call good debt.
Yeah.
You know, mortgages, that's a good debt because every time you pay it down, you're building equity, building wealth. But there is a significant amount of debt that is revolving debt. And unfortunately, like you said, because things are so expensive, some customers are only making the minimum interest payment.
Yeah.
So their balance doesn't go down, and therefore it doesn't improve their credit score or really their financial situation in general. And so we are more than happy to pay that out for them. And because we offer contract requalification, we can potentially pay out more than what another lender could pay out for them.
Yeah. And that's a great point. And contracted qualification will help you a lot.
Exactly.
And one thing I would like to point out here is that, again, a lot of people, when it comes to thinking about, oh, I don't want a B lender, uh, you still will be paying a lot less than 22% that you are paying on your credit cards. If
Exactly.
that's what you think, that I'm paying a higher interest,
Hmm.
just compare it to where your situation will be after you do the debt consolidation, and you'll see a significant increase of monthly cash flow in your pocket.
That's exactly it. And I think that's a very good point because some customers have a tendency to compare mortgage to mortgage,
Yeah.
right? So they're thinking, well, at this lender I can pay $2,000 a month for my mortgage, but at this lender I'm paying 2,400.
Yeah.
So why would I pay 2,400? Well, the reason is, in addition to paying 2,000 on your mortgage, you're also paying 300 a month on this loan. You're
Yeah.
paying 700 a month for this car. You're paying another 500 for whatever it might be. But this 2,400 might be able to consolidate all of that.
Yeah.
So by deleting these other cash flows, it's much, much more valuable to the customer to increase their monthly mortgage by 400.
Oh, that's a great example and a great way for someone to understand
Mm-hmm.
how this will actually help them. And yeah, do interest rates differ if the credit is lower or higher?
Of course it does. And that's a very good question because sometimes customers talk,
Yeah.
and they'll go to one lender and say, oh, you know what, I got a rate of 5.5. Their friend goes to that same bank.
Yes.
Not only do they get declined, they go to another lender that's offering maybe 6.5.
Yeah.
Well, behind the scenes, the first customer has a 750 beacon score. Second customer has a 630. Big difference
Big
in
difference.
rate.
Yeah. And usually, for most lender, the cutoff is a score of 680.
That's where you get the best pricing.
That's
Correct.
where you get the best pricing. So, and the way for someone to be over 680, I think, is just by paying all of their bills on time, keeping the utilization low,
Correct.
under 50%, and you'll be way over 680 with no issues at all.
I agree. The reason scores drop is when people live outside of their means, right? So, just personally, the way that I use my credit card is I think, can I pay this with cash now?
Yeah.
If the answer is yes, I'll pay it on my credit card within a week or two, pay it off using the cash that I have. And that way I'm building my credit without overextending myself. Whereas if you just pay with credit card without thinking whether you can pay it in cash, that's when you fall behind on payments.
That's correct. And I think a lot of people actually make this mistake. They think, I don't want to say something that not you might want to hear, but a lot of people think that the credit card, if they have $3,000 limit, they got $3,000 in their hand.
Yeah.
And that's not something that you should think of it as.
Correct.
It's a tool for you, and I do personally, I use credit card for all the transactions.
Mhm.
But I do want to pay them off on time, because credit cards, they do give you a lot of points or special credits.
Oh, yeah.
And I'm able, like, I get a lot of benefits from them. Even
Mhm.
this podcast we are recording, this stuff that I bought was actually from the points I received from
Oh,
using my credit cards.
yeah.
So,
Lots of benefits for sure.
yeah. So yeah, it's going well now. But
Mhm.
do pay off your credit cards. And one thing, the people who are afraid of credit, there are some people,
Right.
and I've seen that they'll use their credit card and they'll pay it off the same day.
Right.
For them, I would like to say that don't do that either, because nothing goes on to your credit bureau then.
Yeah.
So wait for some time, let your monthly statement come and pay it off.
Exactly.
Okay. So I think we are good with the credit part, or do you have any final tip for our viewers?
No, I think we covered most important parts.
Okay. It's been great talking to you about first-time home buyers new to Canada, investors, and there's one thing we haven't touched on, and that's business for sale and
Mhm.
commission earners. There are a lot
For
of
sure.
people who do not qualify at a traditional bank,
Right.
because we all want to save money on taxes,
Of
and
course.
that's one of the major reasons. Because as a if you're using an accountant, their main job is to help you pay as much as less taxes as you can, but
Hmm.
at the same time what happens is that it takes you out from qualifying at a main bank.
Right.
So in this scenario as well, NPX would come in, and we do, I think you do stated income.
Correct.
So how does that process work?
Right. So I think you brought up a great point because in Canada, at least, you basically choose what you want to pay.
Yeah.
Do you want to pay your taxes or do you want to pay your mortgage? And when you do the math, it makes way more sense to pay a little bit of a higher rate,
Yeah.
but save a more significant amount on taxes. So as the world evolves, as we more people work from home, as more people are specializing and can become contractors,
Yeah.
I expect the world to shift more towards BFS.
Yeah.
The way that we look at BFS or stated income, as you say, there was a time about maybe 10 years ago when stated income is exactly that, right? You write your income on a piece of paper, you give it to
Yeah.
a lender, and the lender goes, here's your money.
Okay.
Nowadays, stated income is less stated, but what we don't rely on are the traditional tax returns,
Yeah.
right? So verifiable income borrowers, they'll use T4s, T1 generals, notices of assessment to
Yeah.
quantify the income. BFS customers, for the most part, we use their business bank statements to quantify them. So we like to see trends. So at NPX, we take a look at anywhere from 6 months to 12 months of bank statements. And we want to make sure that the inflows and outflows make sense for the business
Yeah.
and is enough to help them afford
Yeah.
the mortgage that they want. But 12 months bank statements to six is generally what we look for.
Ah, that's nice. So there is a possibility that with just 6 months of back statements, we can still qualify the person for a mortgage.
Of course, as you can imagine, that for a person that we would want to do 6 months for, they're generally going to be a stronger applicant,
Okay.
right? If they've been in business for 10 years, if we see that they have a very robust website or they have a storefront that we can look on at Google Street View,
Yeah.
because our back office does all these things to kind of verify that business. So if we have all that, you're right. Chances are we can make do with six.
Okay.
However, if they're newer to their business
Yeah.
or they don't have those additional uh, assurances, we can call them, then we might want 12 just to make sure that the cash flow is consistent across the whole year.
And how much of a minimum running time of the business should be to qualify for a mortgage?
For a normal business, we want to see 2 years. That is our standard.
Yeah.
However, let's say we are talking about a very specific segment of BFS, and we're talking those people who have provable, or not provable, but will have proven earning power. People like dentists,
Yeah.
people like doctors. They are classified as business for self.
Yeah.
And let's say they recently graduated and found an office where they could do their practice. We would be able to do with less than 2 years for those type of customers because we don't expect them to run into cash flow problems.
That's
But
true.
yeah, so it really does depend on the BFS, but 2 years is a good rule of thumb.
Okay.
We can talk about less.
Oh, that's good. Yeah. And coming back to the contract rate qualification, is
Right.
it available for BFS or commission earner as well?
It absolutely is.
It absolutely.
Our contract rate program can do owner occupied properties, rentals, traditional income, and the BFS income that we talked about. We
Okay.
want as many Canadians to be able to afford their homes and consolidate their debt as much as possible.
So that means not just for people who are employed, people who are self-employed, they will also qualify for a higher amount with you.
Absolutely.
So that's something for you to note. And
So one thing that we're able to do also is that sometimes when you're business for self, obviously it's not an ideal situation, but you can fall a little bit behind on your taxes,
yeah,
right? Some lenders might want you to pay out of your own pocket before they even look at the application.
yeah,
But one thing that we can do here at NPX is if we don't think that you owing or the customer owing the government money is a trend, a habit, it's just a one off case, they had a bad year. On a refinance application, we are able to use refinance proceeds to pay out those CRA arrears for the customer to get them back to zero.
Oh, that's great.
Yeah, because that does put the customer in a much better position than before. Now, if they're a chronic late payer,
Yeah.
that's a different story. But on a one-off, we are happy to help.
That's a great point that you touched on. And regular taxes that you
Sure.
owe CRA, something that you have to be mindful of, and it is recommended that you pay them off regularly.
Mm-hmm.
And depending on the business, you might have to pay it quarterly or annually.
Yep.
So just make sure you are paying it off on time so that you don't run into any issues. And coming on to property taxes now.
Yeah.
People do owe property taxes as well sometimes.
Mm-hmm.
Will you consider those as well?
We can. We do like to pay them to pay their property taxes on time. In fact, most alternative lenders, they actually pay the property taxes on behalf of the customer. Yeah. It's once you get into the A space with the banks that customers are able to pay their own. Yeah. So for the most part, we take care of it for the customer, but we usually do want those paid on time because it's not a big amount. Yeah. It's a good benchmark for us to see whether the customer is financially sound.
So that's great. One thing I also see it as a convenience for the borrower.
Exactly.
Not just their mortgage is being taken care of, their property taxes are also being paid on time.
Exactly.
And your lender takes care of it. In particular, this case, NPX will take care of it. And coming to the non-subject properties, like if a person owns 4 properties and we are looking for a mortgage for property number 4, mm-hmm. we will need the property taxes for the first 3 properties as well.
So we do want that. We will ask for the property tax bill. Yeah. And obviously we want to see that those property taxes are paid to date. But our focus obviously is going to be on the property where we are lending.
Yeah. Okay, that's fantastic. And coming to the last segment of this podcast now, and that's NPX, a little bit about why NPX and what is the process with NPX, how can a borrower choose NPX, and how does NPX makes it simpler. It's a lot of points, so yeah. Take your time.
For sure. So let's start with how customers access NPX. And I think we talked about this in an earlier portion of the podcast, but I think we're going to emphasize it, is that NPX is not a direct-to-consumer lender. Yeah. We rely on professionals like yourself to first evaluate the customer, compare it with our program guidelines, and make sure that it's a likely fit before you send that customer over to us. So there's a lot of trust from NPX on you, on you to make sure that the customer is solid. So for customers who are on the podcast and would like to qualify for more, whether it's using our contract rate qualification or rental offsets, please talk to Eton, right? Because he's going to get you that access. Once a customer approaches you, the standard information is going to be required, right? So they're going to have to give their consent to pull credit. They're going to have to first describe what income they make to you and then provide supporting documentation. They also need to tell you information such as down payment, what property they're buying or they've bought. And all of that will come together in the application. Once the application is submitted to NPX, at Pineapple, you have a dedicated underwriter that looks at all of your files. That underwriter will reach out to you, discuss the application, see if any changes need to be made. And if we check all the boxes, a commitment will be sent to you, which you would then discuss with the customer. For the most part, our terms are favorable. Our conditions are reasonable. And if the customer is happy with the terms, they will sign the commitment, and the customer will then begin providing documents to you. Yeah. At that point, you and the underwriter will review the documents. Sometimes you will review it yourself before submitting. We do recommend that. And the underwriter will also do a review, just to make sure that whatever was declared on the income, on the application as income or down payment or whatever, matches the paperwork that the customer provides. Once we're satisfied with the documentation, we check it off, and then once all conditions are satisfied, it's in a status that is known as broker complete.
Yeah.
And afterwards, the lawyers will take care of the odds and ends at the end, and you have a funded mortgage.
So that sounds a very simple process, but mortgages can be a little tedious. That's where I come in.
Exactly.
And the way we collect documents is by a very simple portal for easy for anyone to access. Not anyone actually. Those are your documents, so only you can access them.
That's a good point.
And we review it first, and then we submit it to the underwriter at NPX, and the underwriter reviews them. And so it's a simple process if you and your mortgage agent knows what you need and what you need to submit, because the instructions sent by NPX are very clear. The conditions are stated very clearly. What do you need? And once you go over them, I think if a mortgage agent has correctly analyzed the situation of the borrower, it should be a simple deal.
It should be. One thing that I would say for customers that are looking to buy or refinance a home, until the transaction, the mortgage on the home is funded, don't go out and get a new car.
Oh yeah.
Don't go out and buy a new TV and rack up $2,500 on your credit card.
Yeah.
Because things like that can materially affect the deal the closer you get to closing.
Yeah.
So if you want to get a car, that's fine. Wait till your mortgage closes before you get it. If you want to get a TV, fantastic. Wait till the mortgage closes before you get it. And at the end, you'll have the same stuff, but you will find a mortgage process a much smoother one if we do it in that order.
So a lot of people also ask that, does a lender pull a credit bureau more than once after they submit an application?
So at NPX, we don't pull credit. The agent will pull the credit usually once, and then we will use whatever is provided by the agent as our credit bureau. At renewal, we will pull what is called a soft hit. We will only look at the score, but not the repayment habits of any of the facilities that they own. And the advantage of a soft hit at renewal is that a soft hit will not affect the credit score. Whereas pulling a full brand new bureau will affect the credit score, and not in a good way.
Coming back to the point of buying a car or buying a furniture, that only doesn't affect the credit, but it will also affect any closing costs that you might have to pay at closing. Until the deal is funded, nothing is done.
Yes.
And the moment you get your keys to your house, you can do whatever you want. But before that, just understand that before making any big financial decision, contact your mortgage agent first.
Yeah, timing is everything.
Okay, so thank you for joining me. And is there any final tips or any final conclusion that you would like to say?
I just had a great time being on this podcast today. It's been great being able to chat with you and talk a little bit about NPX too. So any questions customers might have, just please reach out to Udit. He is a wealth of knowledge. Don't let his young age fool you. He knows more than meets the eye.
Okay. My contact information is below. You can reach out to me at any time. And it was a pleasure having you here. And thank you so much.
Thank you, Udit.